Good morning, traders. Today is Christmas morning. I am up early and we are preparing for our Christmas morning. Thought I'd try to get this last video out of the way. Was running errands yesterday, and I want to let you know that yesterday was a beautiful day out here in Southern California. We actually had to run the air conditioner most of the afternoon. We got up to about 78, I would say. Felt like about 82. Was running around in shorts and a tank top. Southern California Christmas. But, compared to the rest of the world, it seems like Southern California has its drawbacks. But boy, Christmas and winter can really be nice when we get these bouts of 80, 82 degree weather. Okay, so this is the custom index chart. And today we're going to start things a little differently. I have the custom indexes ready to go through. I also have my server ready to go through with the ES chart that we're going to talk about here in a bit. But first, what we are going to do is we are going to take a look at a S&P chart, and we are going to do some analysis. I'm going to show you kind of what I look at and how I take a look at price trend and technical analysis as we move forward. And then we're going to try to confirm or deny what I call failure to fail or failure to succeed with regard to our expectations going into the end of this year, which is only about a week left, and then into early 2023. So we're going to start here in TradingView with a basic SPX 500 chart and a weekly basis. We're going to first off take a look for what are called standout highs and standout lows. So we have a standout high right here before COVID. Standout highs are high prices that have been reached that have no basis in prior history. And they operate as key support resistance levels. Now we have another one right here, which I will highlight. And then we have another one right here, which I will highlight. Now we have a bunch of them, but we're looking for ones that roll downward for a period of 10, 12, 15 weeks, roll downward for a period of 10, 12, 15 weeks, and do not come back and restructure price. Now this is a standout high or a unique high, but it rolled back up fairly quickly. These have all rolled back down, and obviously we have the ultimate high right back over here. So these are all critical resistance levels in terms of identifying what are called standout highs. Now we have a couple of unique highs moving down here. These are highs that hadn't been reached for 8 to 10, 12 weeks, and this is a high that hadn't been reached for about 8 to 10, 12 weeks. These are more immediate resistance levels. So I'll draw these, but I'll change the color, make them kind of a light red color. So this is one thing that you can do to understand Fibonacci price theory. And then what we are going to do is we'll draw one more up here because it was a unique high. And then we're going to try to find some of these unique standout lows. So right now we have a unique standout low here, which has been breached. We have a unique standout low right here, which is the current low. I'll draw these in green as a support level. Then we have a unique standout low right here, which was briefly breached. And now understand that price can move below a unique low, just like we saw back over here. And that can happen, and it is a viable move. This is essentially a testing of this low. It moved below it, called a scouting party, and then it rolled back up to the upside, which means it failed to succeed, failed to break below this low and establish this new low down here. And these are the critical lows that I see on the weekly chart, the critical highs that I see on the weekly chart. Obviously, if we scroll back, we're going to find some others. For example, this 2015-16 low, you can see it's a double low right here. I'll draw right across here. And so now we've identified some real key critical support levels. So now at this point, we're going to go back to a major low, which is back down here in 2009. And what we're going to do, ladies and gentlemen, is we're going to try to find some critical angles. So WD Gann was very good at trying to find critical angles that projected forward. And I will dotted line. And then the one that I know exists that many people fail to see is off of these initial impulse moves. And I want you to understand that the initial impulse move in the market, trying to get this exact high here, is oftentimes overlooked as a critical feature in the market. So what we're going to do is we're going to highlight this in kind of a bluish color, make it very thick, make it dashed. And why I am doing that is because this impulse move off of these highs here, this 2009 all the way through 2011 initial move higher, was very important as a price channel. As you can see, the entire upward move stayed within this range until we started to get into excesses over here. Now we've come up above these excesses, come right back down to these lows, found support, and this support could be very, very important going forward. So we have these lows off of this bottom. I'll change this as well to a different color, make it a dash line. And if we were to try to identify from these previous peaks and possibly up to this COVID peak, let's see if there's any validity here. Up to this COVID peak. Well, it looks interesting. I will leave it. I will change it to a light purple and make it a little thicker. Maybe make it a solid line. We'll see how that plays out. Okay, so what we've done here is we've identified some levels that we want to try to look at. Now, understand that when we try to identify these levels from a standpoint of confirmation or denial of validity, obviously this dashed medium line here plays a very important role as longer term support. You can think of it as a lower upward bias below here, and then you can think of it as excess bias, upward bias above. So you can see here we got in 2018, rolled back below, broke above it, rolled back below, hit a deep low here in 2018, then rolled back above it before COVID, then came down to a very deep low, then rolled above it through the excess speculative bubble after COVID, and now we're right back down here near these lows. Now, what's to say that the market couldn't come back down below these areas and retest these lower areas? Nothing. It could happen, and that's why we're trying to pay attention to what's happening here to learn how the markets are going to work. Now, the markets have already deflated. In fact, let's take a look at how much the markets have actually come down from these levels down roughly to these levels. You're talking about 27% roughly on the S&P 500. So we've seen a 27% decline, which is a pretty solid decline. And understand that that is a fairly common Fibonacci level as well. 2.18 or 25%. So we're at 27%. If you figure right to about here, that'd be about 25%. This is a fairly common decline in the market with regards to pullbacks. So now we've identified some areas here that look fairly strong as far as trending and support and resistance. Ultimately, what we're trying to do here, ladies and gentlemen, is identify whether or not we're going to see some real strong upward trend. Now, one of the indicators that I really love, and I will add it here, is this zigzag indicator. The reason being is the zigzag indicator helps me see trends in the market. Now, I normally turn off all of the displays, so I don't necessarily need all of these numerics. And what I'm looking for is to have it identify clearly the reversals. So when I look at zigzag, and what I want to try to do is see if it identifies these trend channels efficiently. Okay, so you can see here we've got these reversals. I'm going to leave it just the way it is. It looks pretty good. What I'm looking for is these up-down reversals in trend to be fairly cleanly identified. Okay, so what we're going to do now is we are going to take a look here at the predominant trends. So you can see, in fact, let me add another one and I will show you how I could deploy this as longer term versus shorter term type analysis. So we'll turn this off. We will change the color to, let's call it green. And what we're going to do now is, because this is standard, we're going to change the deviation and we're going to change the pivots. And it's a little too much, so we're going to change this back down to 20, possibly back down to 10. Okay, now again, we move this out of the way. What I'm looking for are major pivots now. Let's change this to make it kind of a purpley color. So what I'm looking for here is to catch major pivots. So is this a major peak? Yes. Is this a major low? Yes. Major peak? Yes. 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 And now we don't have anything down here. Okay, so this looks good. I can work with this. Let me see if I can increase the line. Nope. So style, visibility. Okay, good enough. So what I've done here is I've got a shorter term zigzag and a longer term zigzag. The reason I do this is because I'm looking for critical peak and trough levels that operate as major resistance levels. And the way I do this is very simply, I look for the last major trend. This is the big upward trend. And I will go somewhere down here in the middle, normally right around 50%, and I can eyeball it pretty well. And I will try to draw a horizontal line at that level, and I will try to change the color to let's change it to a deep green. Let's make it very thick. And this is going to be a major support level as 50% of this last confirmed trend. Now, I would also do the same thing here. We had this rotation here. So I would look approximately in the 50% area here, right around there, and do the same thing here. I would do the same thing in this uptrend, roughly 50% of this area, and say, okay, we have major support right in this area here. And lastly, we have big trend down here. And I would try to draw a major support right in this area. Now, as far as major resistance goes, okay, this area happens to be 50% roughly of this downward trend. So again, we look at this downward trend, we look at this downward trend, we look at this downward trend. We have an area right in here. In fact, let's do this as a box, because this is kind of 50% of this trend here, this downward trend, and 50% of this big downward trend would put us right in this area as pretty major resistance. And that would, again, if I draw a line, that would be probably somewhere right in this area as resistance. And I'll make that dark red, a little lighter. And then we have this big trend up here, and the way I would look at this is about 50% of this area, get my mouse to cooperate, puts us major resistance right here. So now what we've done is we've identified major peaks, major troughs, and then I'm looking for these 50% retracement areas. In fact, let me see if I can grab this one, that one, and change the color to a little lighter. All right, well, I got everything but the other three. So change this to a little lighter, change this to a little lighter, and change this once I can get it to a little lighter. Okay. Got everything fairly well set up. So now what I've done is I've gone through and I've highlighted the price trends, the price channels, the Fibonacci price highs and lows, which I look at continually, and I've kind of mapped out here what's likely to take place with regards to price. So understand that the way I'm interpreting this is that as long as we stay above this level here, in terms of trending, this operates as a support for the market. We do have this major resistance and a series of resistance channels right over here that are going to operate as key trigger levels for price. We need to see price move above these levels here in order to reestablish an upward trend. It is in a downward trend. It is consolidating. The only thing we have with regards to support and the objective side of the fact that this market might be trying to find a bottom is these deep lows right here. So when you come take a look at this and spread it apart, get a little closer look, you can see that this is a very key support level, 50% of this previous move to the upside. It lines almost perfectly with this. We have this long-term support channel here, aligns almost perfectly with this. We have this previous high back over here, which we're just above. So in reality, we have a pretty decent support channel right in this area. And this is one of the key indicators to understand that price is attempting to hold at this level and may attempt to retest these lows back over here, but it is attempting to hold at this level. We do have this level as an upper channel, which means that as long as we stay above this upper channel right here, we are looking at a potential upward, let's call it upward excess phase. So if we get back up into this area, we're going to be back up into an excess phase again. Have we seen a sufficient downtrend? Well, that's kind of difficult to tell at this point. What I would do is I would clone these. So I would clone this line and I would attempt to drag it down to previous highs. So I'm going to mark it right here. And what I'm looking for here is it aligns with this high, it aligns with this breakdown here, and it aligns approximately with these lows here, and then through the midpoint channels here. Remember, the midpoint channels are very important in my opinion. So I'm going to modify this a little bit, turn it into a dashed dotted line, and I will clone this and try to move it approximately the same distance out here, almost like a pitchfork. Visually, it's got to look pretty close, and I would say that's pretty close. So here we have a price channel, which gives us an indication of how far logically the markets would operate within this volatility range. As long as we're in this channel, moving upward, we are likely to see upward trending. So again, we have this channel here, we have this upper channel here, and we have this middle channel here, which is off of the highs. So this gives us kind of a boundary here. We could be in upward channel territory here. We need to see it break below this support level, which we haven't seen it do yet. And then ultimately it's going to then try to potentially come down to these levels here, which would act as very strong support here and here. Okay. So what we're looking at now is we're looking at the trend channel with regards to the markets. And if we take a look at, and the way I like to look at these Fibonacci levels and these rotations in price, is we would look at the last major confirmation of trend, which basically is this level here. So here we have this massive resistance channel right over in here. And this would be what I would consider the key element to determine whether or not we are going to continue to move higher. We have this massive resistance level down here and this massive support channel right here. And this is where I see the markets potentially flagging out and attempting to move and break outside of this range. So understand that we really have a window in this area, which must be broken to the upside. And we have a window in this area, which must be broken to the downside in order for us to initiate a new trend. We are holding above very critical long-term, essentially 14 years support right in this area. This level right here is very, very important. In fact, I'll make it a solid line. Try to make it as bright a color as I can. I'll make it a bright yellow. Let's try orange. This level here is massive, massive support, going all the way back to 2009, 10, 11, 12. And this is something we need to watch very solidly. Right now, that support, and as we move into the end of the year, is going to be at 3660 roughly on the SP 500. And then we have massive resistance right over here. And again, if you can take across the highs of this channel, we can obviously come right across these highs. And you could essentially say that we have this channeling formation. In fact, let me draw this here. And come in. No, I don't want that. Cancel. And do not extend the price channel. So here is our basic flagging formation. You can see this setting up as a rally to the upside, coming back down to this area, up to this area. And ideally what would happen here, ladies and gentlemen, is that we would see a rally phase like this. So let's just start it right here. Rally on up, moving down to this level, up to this level, down to this level, and then eventually rotating out to the upside. And this is what is very likely to happen. Try to find a nice color for you, something that you can follow. Heck, let's just go with yellow. So ideally, ladies and gentlemen, we have this type of a flagging formation. We've seen the pullback. We've seen what I believe is support. We've seen the A, B, C, D will come down into this area, possibly into this area, and then eventually flag out and move to the upside. And this is where we start to, whoops, get rid of that. And get rid of that. And this is where we start to move into broader upward cycle trends. Okay, so now let's try to take a look at this from a monthly basis. From a monthly basis, we have the same lines being drawn. We have the same zigzag channels. They're very clearly defined here. In other words, we have the same ultimate peaks, so to say, and rotation. We do have this midpoint channel here, which is very solid. This is the downward cycle here. We have, you can see this upward channel trend off of 2002 here is playing a very important role. You can almost see this trend line extend right here into this purple. And this is an upward channel slope that is acting as support right now. We're right at it, right below this level right now. And where are we in the longer term scope of things? Well, obviously, we're in this sideways channel. We need to see some sort of a change in trend. We have this resistance up here at 4,200. We have this support down here at roughly 3,550. Remember, I'm on a monthly chart here. I've identified this channeling trend, which we look like we've moved up into this XSV. So what changed here versus here with regard to this activity roughly right here onward? So what changed? What changed is a core structure related to taxation in American corporations. When President Trump was elected, he signed a bill that changed corporate tax structure, and as my friend and my associate explained to me, this provides roughly a 10 to 15% additional revenue savings for corporations, which translated into a big increase in bottom line or net earnings for corporations in the United States. So understand that we went through a period here where we had this ramp up here when President Trump was elected. Taxation levels changed, vertical line. So November, right here, roughly, that's when President Trump was elected. And he was taken into office in January, which is basically right here. And what happened here is a change in corporate taxation. a decrease in the corporate tax rate, which sparked an economy. Remember, the Fed at this point was already raising rates, and it was moving towards a more normalized structure. The change in taxation provided additional earnings, additional revenue for corporations, and really prompted, when you get right down to it, the shift in the Fed policy here in 2018 went back to near zero. Then we had COVID with zero. Fed was still in quantitative easing mode at this point. We had COVID stimulus. We had the economy essentially on steroids. And now, if we get right down to the concept of where we are going to end up in kind of a broader cycle trend, it would not surprise me if we rolled into this area sideways and melted upward. Okay, now that's kind of a bad example because this is a monthly chart. So ideally, let's try this again, and we would melt into some sort of an upward trend, possibly into new highs, and then ultimately 26, 27, 28, maybe back over in this area. And this is what I believe is most likely to happen right now, in the sense that we have this support channel. We may come down and retest these areas. If there is some sort of a crisis event, we may come down and retest these areas, 28.30, 28.50. But ideally, if there is no crisis event and we flag out into this formation, we're likely to continue to flag out through, let's call it, middle of January 2023, maybe into early February 2023, which would put us right about here and right about this area. Let me draw a line. So right about, I'll go back to weekly so we can get a better picture. And March, February, so right in this area. Make it a big blue line. Right in this area is where we would likely see the end of the cycle phase with regards to the flag. So we have this drawn in this area. This red box here is telling us what happened with regards to the Trump tax cuts. I'll get rid of it. And what we have now is the potential for a broad cycle flagging formation. Change this to a bluish color. And so this is, again, the flagging formation, the A, B, C, D, and then eventually E. We could flag out all the way into April at this point. So understand that we could continue to flag out sideways here into April. My thinking, though, is that somewhere around the middle end of February, somewhere possibly in this area, we're going to look at the end of the flag, and we're going to start preparing for Q1 2023 earnings and start to move higher. So from a technical standpoint, this is a very high level technical analysis of market trends. We have this deep, deep channel, and this one still looks a little high, so I'll bring it back down. Roughly about like that. You see how it aligns here with this peak here? That looks about right to me. So we would be looking at this type of a breakout rally, and we would be looking at an upward melt up. Now, it could be much more aggressive. It could take 2023, maybe 2024, and get back up into this area here. Eventually, I think we're going to move into new highs and peak somewhere near 2028, 2027, back over in this area. And I think we could see the S&P move up to about 5,700 to 6,000. And understand that if we go to a Fibonacci extension and we take a look from basically these lows to these highs, come on mouse, and come back down to recent lows, this puts us at a full 1% extension at 59.66, or a 618 extension would put us at 50. 5027. And this is about where I would expect the first little resistance. So understand that as we move higher here, we would likely come up to around this 5027, 5030, 5035 area, find some resistance, stall out a bit, and then attempt to move higher up into this 5966. So again, let's call it 5965, but that would be a very good target right over here. Okay, so you've kind of gone through the whole concept here of how I am looking at things. Now, again, I need you to understand that barring some massive collapse in the markets, this is likely to be what's going to happen. And if we have some sort of a COVID crisis or financial crisis take place, I think the markets are settling and moving into a new environment in 2023. So we'll see how this plays out. Now let's go over to the custom index charts before I spend too much time looking at charts. I hope you enjoyed that, and I hope you take a look at how I am studying the markets and going through everything. Let's look here at the custom index charts. Cash flow index is a little bit higher last week. We're finding some support. It's the end of the year, ladies and gentlemen. It's probably going to flatten out. I would not be surprised to see this attempt to move a little bit higher in anticipation for 2023. This is a weekly chart. We've broken through this downward cycle trend. We need to get above this resistance level to see some continued upward trending. The consumer engagement index, very, very interesting. Look at this low. Look at how this is set up here in another deep, deep low. This is, again, off of the Fed. This is consumers pulling away from the economy. This could be a end-of-year bottom. Kind of like we saw in 2018, which I believe is right over in this area. I'll show that to you, but this is potentially another retest of this deep low. We need to see how this plays out. And if consumers continue to pull away, we could see the economy move into a deeper sideways consolidation. But consumers are moving away from excessive expenditures. This is a sign that we are seeing more consolidation and tightening in the economy, and this is not a good sign for us right now to see the consumers at this level. Again, this puts us way back down over here in the 2012-13 levels. Next, the large cap index breaking downward again. You're seeing the large cap index move lower, hoping that this is a basing bottoming formation in the U.S. markets. We'll see how things play out. Fed raising interest rates again, and the U.S. markets, like I said, consolidating deeper to the downside. Was hoping we would see some sort of a base or bottom. This could actually be a deeper low. I understand that like this, we have these deep lows come into play. We have a moderate contraction right now. We're going to see how things play out and how the economy continues to perform going forward. We have a custom global asset index is again at new lows. We are seeing end of year be very weak right now, which, like I said, could be very similar to the end of 2018, where we saw this broad weakness. You can see here, same thing happened here in 2013. Broad weakness in the market through the end of the year and into early next year, and then it changed direction. So we need to just be patient and be safe. Custom gold index is still showing accumulation. I mentioned this to you last week. Gold and metals are forming an accumulation base right now. I would expect gold and silver to continue to attempt to move higher as we continue to get more accumulation. Accumulation is kind of like this. You start to see an early basing pattern in this 40-50 area, and then eventually we start getting into what's called appreciation trending, speculative kind of a bubble peaking. And right now we're in very early stage accumulation for gold and silver. We could see it accumulate all the way up into this 45-50 area and then attempt a speculative bubble peak. The custom fear index moved a little bit higher. It's not excessive. 7.48 is not excessive. It is enough to keep us cautious. It is enough to be aware that market trends could move downward. This is the SPY. Using the super trend pivot. You can see here that we are in this correction phase. I showed you this flagging formation setting up in the other chart. and our custom leading index is moving upward as well. So you can see that we have upward trending, meaning capital is moving into the U.S. markets, expecting a base or a bottom down near these deep lows. You can see these deep lows. These were the COVID lows. This is the current lows. These are fairly deep lows for the market. In order for us to actually see something even deeper, it would have to be, in my opinion, something very severe, something of a crisis nature. Next, we have the tech ratio index. Tech ratio is basing and bottoming. Boy, this has been a struggle through the end of the year. We'll see what happens early next year, but remember, we've been safely protected with the Mint rotational modeling system. Even though I do believe technology is going to recover quite nicely over the next 12 to 24 months, we are still seeing this under severe pressure. You can see the RSI and stochastics have pretty much based and bottomed out here. So again, as we move into 2023, we could see a nice little pop, but we're not seeing it yet. Okay, next, the custom U.S. to global market index. At this point, ladies and gentlemen, we're seeing the U.S. market flag back out here into the sideways pattern. Global markets have rallied and stalled last week. End of the year, I hate to say it, but what do we expect with the Fed raising rates and no real impetus for a rally phase yet? Q4 hopefully will come in 2022 will come in fairly strong, but we need to see these support levels hold. So right now we've got a support level back down over here, which is this level here. We need to see markets hold in this level, and I would like to see the U.S. and global markets enter a breakout phase to the upside, which may happen by the end of January 2023. But right now we're just not seeing any real impetus. So what I can tell you is, like I said, from a trader standpoint, buying or taking small token positions in some undervalued technology stocks may be an advantageous play right now. But we're just not seeing any real upward movement yet, which is why, like I said, it might be smart to take a couple of small token positions into some undervalued technology stocks, Tesla, Microsoft, maybe Disney, things of this nature, where we could see a moderate reflation trade. But we don't have any real indication that the upside move is building any momentum yet. So the only advice I would offer you is, as you're looking around at some of these deeply undervalued stocks, remember, you still need to be cautious. Do not get overly aggressive in trying to acquire any of these deeply undervalued U.S. stocks right now. Okay, the custom valuation, U.S. custom valuations index, weakening again, back down here near support. This basically shows us that over the past 4 months, all of this selling, really, we'll call it 3 months, has consolidated down into this lower channel, which is back across here, these channels right here. So we would really need to see some deeper move to the downside before we would see some sort of a consolidation period. There is this very strong likelihood that this move, as you can see, has devalued quite a bit from way up here down to this area. There is a very strong likelihood that we're nearing a bottom, nearing a base at this level, but we don't have any real confirmation to the upside. This is a monthly chart, so we're probably not going to get it in the next week, but we'll see what happens over the next 2 or 3 weeks. We are in a downtrend, which is why we're cautious. Remember, the Mint rotational modeling system has got us 80% cash, 20% into stocks for discretionary trading, meaning that you are safely protected. You can still trade, but you should be safely protected sitting in cash right now and only trading 10 or 20% of your capital in any new trades that you take. Custom leading index. Yeah, oh boy, look at this. Everything else is bearish, but we've seen a very solid accumulation phase take place. This is a weekly chart. We've seen a very solid accumulation phase take place. We are stalling out near the end of the year. We need to see this hold up. It is holding up very well right now. Ideally, we would see this base and bottom into 2023 and maybe attempt to move up into this 2.2, 2.4 area, which would be very positive for the start of 2023. If we can get up out of this channel here, we could be looking at a nice reflation trade back to the upside. Technically, ladies and gentlemen, as long as we stay away from this green area, green and blue area right here, we are in a moderate reflation upward trend already. Okay, so it's starting. We're seeing accumulation. We're just not seeing it translate into the broader price charts yet. Volume ratio index had a little bit of an uptick last week. To me, this is nominal, repositioning before the end of the year. We could, in 2018, we had a bottom in December 24th, and the markets turned around and started accumulating very quickly near the end of the year. We could see something like that happen. I mean, at this point, I would put it at 50-50. But again, ladies and gentlemen, you can see here this spike that we took place here in 2018. This was it. 2018, the bottom took place. We had a big upward spike in 2018, which was the buying volume, the accumulation coming in. And we could see something similar to that this week as we play out the end of this year. It's not too often that it happens, but it could happen. So we need to be aware that this is a very solid, consolidated bottom back over here. And then we saw that big buying volume kick in December, the last week of the year in 2018. We could get the same thing here. Pretty good spike up here would show that traders are anticipating a reflation trade in 2023, a big upward move. Commodity to gold index is flattening out. This, as long as it stays above, let's call it 0.8 to 1.1, we are seeing a moderate reflation trade, reflation of the economy. We would not want to see it move back below 0.9, 0.8. That would mean that the economy, the global economy, is really contracting again. So we are seeing some upward reflation in the global economy. It's just not taking root in the price charts yet. The metals, custom metals trend index. This is why, again, metals should continue to reflate and accumulate. We are seeing this big, broad upward cycle trend in metals. This is a particular, a custom chart showing really accumulation and distribution in metals. You can see here gold and silver and platinum have already started this massive accumulation phase, moving back up towards these previous all-time highs. We could, in early 2023, see this up near all-time highs, pushing further into higher territory. And that would mean that gold and silver would transition back up into gold above 1950, silver above 27, 28, and continue to appreciate higher. Now, if you take a look at this, you can see the ranging, 7,000 up to 11,000. That's a 5,000 range. Then we come down here, 90, let's call it 8,700, up to approximately 12,700. That's a 4,500 point range, roughly. So if we stick in roughly the 4,000 to 5,000 point expansion, this next rally phase could see this target the 1450 area, which is still quite a ways to go. That's another 2,000, 2,500 points higher. That would be approximately a probably 15 to 20%, maybe 30% move in this index. And that would mean metals could be looking at a 25 to 35, maybe 40% move higher from where they're at right now. Boy, wouldn't that be nice. Okay, next, the FANGs index. Really consolidated and basing and bottoming. We're seeing all of this downward pressure here, but we're seeing this downward pricing pressure in a consolidated base bottoming formation. It's not really driving price lower. Could break downward here, but we're seeing it basically consolidate in a downward trend while there's appreciation or accumulation taking place in FANGs. We'll see how this holds up, because a deeper low down here would be probably a very good buy trigger here, but we've already seen this deep low. We've seen it roll into a sideways trend. You can see this flagging formation kind of setting up. We need to see what's going to happen in early January. Better to stay safe and look at just taking basic what I call token positions, very small, 5, 10, 15 shares. Just get yourself into even 2 or 3 or 4 shares. Long and short of it, a little token position indicating that you might want to try to jump into some undervalued technology stocks on a reflation trade moving forward into 2023. Now, understand that this is longer term. This is really holding a position for 12, 24 months around the concept that this could reflate back up into this 350, 375 level, which would be a 40 or 50% reflation trade. The custom metals index weekly chart, you can see that this is a more direct price correlation chart to what's happening in gold and silver. We need to see this move, metals move in a decidedly upward trend. We're seeing accumulation. We're seeing a reversal of trend here. We're seeing fear in these metals indexes move higher. We need to see this move back up into what I call this yellow brick road channel between these two yellow lines. And I believe it's going to happen probably by February, March of next year. I think we're going to see a nice solid melt up trend, and then we're going to stall back up into this area and trying to move forward. So expect a good 15, 20%, 25% move to the upside in metals. I think the fear level is very similar to 2003, 4, 5 right now as far as metals go. This is a very solid base. We're back above it. Yeah, I mean, we could roll back over to the downside, but I think traders understand that global central banks need to settle what's taking place, and I think we're going through kind of a 2003 to 2008 or 9 cycle phase all over again, starting right now. So if I were to tell you this looks very similar to 2002, 2003, in my opinion, an unwinding of an excess. We've gone through an unwound over the last 2 or 3 years. Now we look like we're moving into 2003, 4 type of an appreciation phase, which remember, the markets were appreciating very strongly in 2003 and 4. It was a reflation trade, and it eventually peaked out in 2008, 9. And then metals continued to skyrocket for another 2 years, reaching their peaks. So the smart cash index, you can see here how we've come across this line here and stalled. Very, very important to see some sort of a new upward trending take place. We are not seeing that yet, but it is the end of the year, so it kind of expected that we slide into a nothing end of the year. We'll see what happens. We could get that big bounce next week or the week after, like I mentioned, but right now we're just kind of sliding into a bit of accumulation, a bit of reflation, but really nothing right now as far as trend direction. The U.S. stock market index, same type of scenario, flagging sideways. You can see these support channels. We've gotten down very, very low again off of these lows here. Remember, these were the deep COVID lows. We bottomed off of this. This was a global shutdown. Remember, this was not just the U.S. This was the entire world shutting down because of COVID. We've come down and reached these extreme levels again, gotten down into these support channels, which were the COVID highs, and now we're trying to reflate back out of it. We'll see what happens here. We're a bit low into the end of the year. We do have this same channel setup. So we have our A. We come down here. You can almost see it. B, C, D, and then maybe an E here. So understand, I'll draw it again. A to the upside. B down here, C, D here. Maybe we get that big reflation trade E back to the upside here. We will see. Okay, we're maybe a couple weeks away from that big reflation trade. Custom valuations trend index, weaker again. You can see we've broken this channel again. These are fairly low valuation levels. We've completely unwound the excesses that took place throughout COVID. Now we're looking to try to find a base valuation level, which means that we're looking at earnings, we're looking at forward earnings, we're looking at price to earnings ratio, we're looking at economic functions, we're looking at strength of consumer, we're looking to find some guidance into 2023. Where basically 2022 has been a big unwinding phase, a basing, bottoming, accumulation phase, and now we're looking for guidance into 2023 and 24. The custom volatility index, which is of course one of my favorites. Look at this. We are seeing upward trending. I love this little thing. Upward trending in the custom volatility index really tells us that we're getting accumulation. Through this selling, through this downward pressure, we're seeing accumulation. We're seeing traders see through the crud and start to really accumulate shares down near these lows. So you're starting to see traders and institutional traders start to see some positives. They'll start to see the end of 2022 and moving into 2023. So we'll see how this plays out. Remember, we would need to break this channel, this upward red channel here, very confidently to move back into upward trending, and that would be something that could take place within the next 3 to 5 weeks. So we'll see how it plays out, but we've had this deep unwinding, this reflation accumulation trade. We are seeing this kind of consolidate. It's kind of hard to see, but you can see an A, and then of course I would count this as B, C, D, and now we're in that E phase to the upside. Now that won't translate to the price charts on the SPY and the NASDAQ very efficiently, but it sure looks like we're getting ready to see some kind of an upward move here. We'll see how it plays out. Right now we're consolidating with accumulation in a moderately bullish phase, even though the other price charts are fairly weak. And that's the end of the custom index charts. Now lastly, as I have a little time left, this is what I drew in the other videos this weekend. It may be hard for you to understand, but we have an excess top phase that's rolled over into a flagging formation, double bottom back over here near support. And now we need to see what's going to happen. Ladies and gentlemen, it's either going to be a reflation trade to the upside, which may last 2 or 3 years, maybe longer, or we are going to roll into a deeper correction back over here and attempt to break into a wave 4 trend and move lower. So understand that we're at that phase where we need to see how the market is going to react to this. I will tell you and leave you with one last thing. Generally, the markets are biased to the upside. There's nobody that I know of that wishes for a global collapse, economic collapse. Everybody is planning. You go into business because you want to try to make a profit and earn money. You run an economy because you're trying to keep the wheels on the train and keep everything functional. Nobody is wanting this to collapse. So in all essence, this is a 15 or 20% potential in the sense that this would take a global crisis event to really unwind this type of market trend. In general concept, it is very much more likely that we see some sort of a moderate reflation trade at this point and attempt to move back to all-time highs, assuming we have no crisis event coming into play. So all those doomsayers, everybody telling you that the world's going to end and China's going to take over and whatever, just remember that's counter to psychological norms. The real reality is China doesn't want a war. China doesn't want to disrupt their economy, because if they go to war with anybody, it will disrupt their economy severely and set them back 20, 30, 40 years. The real reality is that we are moving into what's called a reflation cycle, which means that we've unwound these excesses. We have a ton of capital in the market. That capital will be digested and resolved. And then eventually it's going to come down to, are consumers healthy? Are corporations healthy? Are we able to earn? Is the global economy moving away from this deflationary cycle trend? And where are we in terms of earnings and forward progress? That's what it's going to come down to in 2023, is kind of a reestablishing of the pathway forward with regards to global economy, global expectations, and whether or not companies, global economies can continue to perform. Okay, guys, that's it. Merry Christmas. Let's see how this plays out. Remember, don't get overly aggressive with anything right now. Better to just be safe and wait for the markets to tell us what to do. All right, guys. Merry Christmas. Take care.